Hello everyone, let's continue our monetary models. In the previous lecture, we introduced money and money market in our model. Like any market, money market has its own supply side and demand side. But money is a special good because it is usually treated as numeraire. If you still remember what you have learned in macroeconomic theory, a numeraire is the goods used to denominate other prices in an economy. There is a numeraire good in all models. For example, in the RBC model, the real model, the numeraire is simply the output because there is only one output. Therefore, the price or real price of the output is of course 1 because you can use 1 unit of output to buy 1 unit of output. Wage and interest are also denominated by output, so they are called real wage and real interest. In contrast, in a monetary model, all prices, including output prices, wages, and interests, are all denominated by money, since one of money's functions is unit of account. All prices denominated by money is called nominal, such as nominal price, nominal wage, and nominal interest. We have seen the supply side of the money market last lecture. Today, we are going through the demand side of the money market. This lecture has 3 learning objectives. The first one is to know the demand for money is determined by the alternative means of payment. The second learning objective is to know how to derive the money demand function. And the last one is to know how to derive the Fisher equation. So the focus of this lecture is on the demand side of the money market, and this is the 3 things we are going to discuss. As we have discussed when we define money, the demand for money is actually not intrinsic because you don't want money for its own sake. You want money because you want to use it to buy other goods and services. That makes you ultimately happy. So money is a derived demand rather than an intrinsic demand. To understand the determinants of the demand for money, well, by money we mean the cash in your pocket, or M0, or currency in economic terms. It is not those you put in your bank account as deposit. If you want to know your demand for money or cash, you need to know the alternative ways to pay in daily life, because you can either pay by money or by other means. Now let's look at some data collected by Payments UK back in 2016. Cash is the most popular way in the UK when they buy stuff in everyday life. It's 45.1%. It is back in 2016. Probably in 2020 or 2021, it is much lower because you don't want to touch anything that you don't have to in the coronavirus pandemic. But at the same time, in the US, only 11% of people would like to use cash for their daily payment. The second one is, the second highest is actually debit cards. We have this contactless technology. You can purchase goods, just use your phone. So it is 26.6% in the UK, and it is higher in the US, it's 35%. And the third one is credit cards. It's 6.7%, and it is quite high on the other hand in the US. It's 40%. As you know, the US would like to, the US people are very used to this advanced consumption. They would like to spend more than they actually earn. So 40% of the consumption are actually paid without any income backed in your account. Actually, it is related to what we have discussed in the previous lecture. Is credit card money? The answer, if you read the textbook, is that credit cards is not money because it is not medium of exchange. It is simply a payment method. Okay, you are not transferring your credit to another person when you use credit cards to pay your everyday purchases. It's something you pay now and then you have to repay in the future. That is what we we mean by credit or credit cards. Check 1.4% is still used but not that popular. When I came to the UK for the first time, I feel privileged because a checkbook feels like a very noble symbol to me. Only those who have a very big asset will have a checkbook. And so in our school time, when I came here in 2005, I used checkbook a lot because I feel like a noble person when I write a check. Now let's bring this discussion a little bit further. Let's compare these different means of payment in terms of 4 different criteria. The first criteria is whose liability the payment instrument represents. For example, money is the liability of the central bank who issued it. British pounds, for example, is the liability of the Bank of England because they issued British pounds to the public. But for check and credit cards, the liability belongs to the commercial bank who issued it. You use the checkbook or credit card to pay in everyday life because it is backed up by the bank. Okay, the credit card, however, the liability belongs to you because you owe money to Visa, MasterCard, or American Express. They hold your assets and you owe money to them. This is different from previous 3 cases because the liability is yours, not other institutes. The second criteria is whether or not there is interest on the liability. For money or cash, of course, there is no interest on cash. But for check and debit cards, if you have any balance on it, you will have some interest paid to you. But for credit cards, remember, it is your liability, not your asset. So the interest will be paid by you to them if the payment is later than 1 month. But you don't have to pay any interest within 1 month, as far as I know, for most credit card companies. The third criteria to compare them is to see how much are the transaction costs. Well, we all know that check and debit cards and credit cards will charge you interest or service fee. So the transaction cost seems quite high and straightforward, you know that. But how about money? If you use money, is the transaction cost high or low? Probably you would say low because you just use money to buy anything. But this is the case for the UK. If you are in other country with very high inflation, then the inflation will make the money in your pocket depreciated very fast. So today you buy something at £1, but tomorrow £1 is only worth like 50p tomorrow. So that is a very high transaction cost if you have a very high inflation. Also, if this country has a very bad security, social environment, then you can be very easily robbed on the street when you carry your money in your pocket. So that is also a higher risk of using money. It gives you a higher transaction cost. Anyway, the last criteria to compare different means of payment is whether or not physical medium is needed. And money, of course, we use paper or coins. So yes, you do have that. And for check, you use a piece of paper and write on it and exchange it. Debit card or credit card, you don't need to exchange anything. You just put in your PIN. So you don't really need any physical medium to finish that payment. So that's how we compare different ways of payment using different criteria. So our purpose here is to model money demand. To do that, we will have to consider an alternative way of payment in everyday life. So in this case, we will just use credit cards as the only alternative to money in transactions. This is to simplify the case, but actually, as you can see from the data, credit card is a very important and probably the most important alternative to cash payment. Now suppose the goods and services you purchase every day by consumers, by firms, by the government, they are represented by the symbols here. Consumption is represented by C, investment is represented by I, and the government expenditure is represented by G. All these purchases has to be done using the medium of exchange, either by money or by credit. Now we know that if you use money, there is no or very low transaction cost for individuals. But if you are using credit card, it has to be provided by some company. It is very costly to run the company to do all this process. For example, a credit card company has to set up a communication network. You have to be able to tell everyone who is using your service that you can use it, and the shop or the seller of any goods will have to communicate using some POS machine. Whenever you pay it, you use a small machine there. It's called POS machine, and this is a communication network which costs money. And the credit card companies also have to check the credit histories of individuals. Not everyone can have a credit card. Having a credit card in the past is a symbol for being a good person, because you are behaving yourself, you are not doing anything naughty, and then you will be able to have a credit card. And also you have to send these monthly bills every month. Although nowadays we would like to use a paperless statement, but still someone has to set it up and doing all these statements. If you use cash, you don't really need to do any statement, right? You just pay for it. Right. Also, these credit card companies also have to collect debt payment. After you use the service, you have to repay what you owe to the company. If you don't, then it's like the mafia. They will have to send someone to cut your fingers, right? Just joking. But anyway, they will have to spend some efforts to collect the money you owe to them. And the last one is, if someone is really broke, then they will just default. And if they default, you will have no money back. So all these costs to the credit card company means that you will have to pay something to keep the service going. Similar to supply curve of any goods, the quantity of credit supplied is increasing in the price of credit. Let's use XS to denote the supply of credit, or the units of goods purchased by credit, and Q as the price of credit card services. We know from microeconomic theory that a higher quantity of credit produced by the service is associated with a higher marginal cost, and the optimal condition of credit card services is to make sure the marginal cost equal to the price. Therefore, as the price of credit Q increases, the increase in marginal cost gives a higher corresponding quantity of credit XS. So that is why you can see this upward sloping supply curve of credit. It is actually the same as any goods in any market. If you really want to know the economic logic behind more precisely, you can derive it from the maximization problem of a bank. That is, to maximize the profit of a bank subject to the production function of credit. But to save your time and save your burden for your exam, we ignore that here. But after all, you just know that everything you see from this graph is derived or can be derived from a mathematical question. Seeing that using credit card is actually costly, you have to pay for the services provided by the credit card service. And also, using money is also costly because you have to give up the interest on the balance of your bank account if you use the cash instead. So both are costly. What you are doing is really making an optimal choice between money and credit card so that you maximize your net benefit, which is defined as the total benefits minus the total cost. If you have to buy everything by money or credit, then here is accounting identity. The total output you have to purchase is equal to Y, and P is the nominal price of these output. So P multiplied by Y is the total demand in nominal terms. They have to be paid either by money or by credit. If the credit you are using to pay is equal to XD, standing for demand for credit, then you have to multiply that real unit of credit by P as well. P is the nominal price, and MD is demand for money. So basically, you are choosing between XD and MD to optimize your transaction cost. So at the margin where you optimize, the marginal benefit of using credit must be equal to the marginal cost of using credit. We know that the benefit of using credit is you will be able to save the money into the bank and then get this nominal interest rate R. Okay, R is the nominal interest rate. So if you use credit, you will get this benefit. But if you use cash, then you won't have this nominal interest earned on your bank account. But you will also have to pay Q to use the credit. So the marginal cost of using credit has to be equal to the marginal benefit of using credit. R has to be equal to Q at the optimum. It is actually a general principle in economics when you optimize. The marginal benefit has to be equal to marginal cost. In our case, the marginal benefit is the interest rate you could earn by using credit. And the marginal cost is Q, which is the price of each unit of credit you used. So R has to be equal to Q. If R is greater than Q, then the individuals will overwhelmingly choose credit over money. So no one is going to use money at all because this is much costly. And reversely, if R is less than Q, then no one will use credit because credit is too costly to use. Only when Q and R are equal, then we are in equilibrium. Individuals are indifferent between these two choices. So the demand for credit or the demand for money, they are actually the same thing. Once you determine the credit, you will determine the demand for money. So R equals to Q is the condition for you to make the decision between how much money to use and how much credit to use. That is why we start our discussion of money demand with the discussion of credit demand, because once the optimal demand for credit is determined, the optimal demand for money is automatically determined. To see that, we go back to our accounting identity for the aggregate demand. In nominal terms, PY is the total nominal value of the output you want to buy, and you either buy it using credit, which is equal to P multiplied by X. XD is the demand for credit, and you can either also buy it using money, so MD, which is the money demand. If you rearrange it a little bit, you will have MD equals to P, PY minus PX to start with, and then you factor out P, so you got this new expression. We do that because ultimately we want to know what is the money demand in this model. So money demand is basically equal to P multiplied by Y minus X. Okay, we change X from XD to X star because it is in equilibrium. In equilibrium, it is X star. Right, remember that X star is actually a function of R. To see that, let me show you the reaction chain here. We start with the change in the price of money. Okay, this is typical for all economic analysis. We always start the analysis with the change in the exogenous variable. This is a competitive market, so the change in price is exogenous. We are all price takers. in this particular case, it is money market, right? So the price of money is R, the interest rate you have to forego if you use cash to purchase. So the price of money, R, increases. That means Q has to increase. This is because we have just mentioned that equation in the equilibrium. Marginal benefit equals the marginal cost, right? R has to be equal to Q. So when R increases, Q has to increase. And when Q increases, according to the supply curve of credit, X has to increase because it's an upward sloping curve, if you remember 2 slides away. So when X increases, MD, the money demand, will have to decrease. The last reaction chain, this part, is because when X increase in the previous equation, this identity we just derived here, X increase means minus X will decrease. So money demand will decrease. So according to all the analysis before this slide and the rearranged equation in this slide, we can see this reaction chain. When price of money increases, which is R, increases, then ultimately we will have a decrease in money demand. So to summarize, MD drops as R rises. So basically, it's still the same as any market. When the price of something increases, the demand for that thing will decrease. This is a negative relationship between R and MD in this particular money market case. So in general, we can rewrite the money demand function in this generic way. We just replace the bracket in this identity, y minus x, as a liquidity function, L, which depends on both output, y, and interest rate. But we know that money demand is positively correlated with P because P multiplied by L. L is a function of Y and R. And output is positively correlated with money demand. So we have a plus to indicate the positive relationship. And interest rate is negatively correlated with money demand. So we use a minus in the subscript to indicate the relationship between interest rate and money demand. Sometimes we call this L function as the liquidity demand or real money demand, but it's basically the same thing as this L bracket y comma R bracket. And this is just a function of these two variables. So up to now, we have been focused on the first two learning objectives of this lecture. The first one is the alternative payment method, which is basically the credit we have been focusing on. The second learning objective is to derive the money demand. And these two learning objectives are actually related because once you know the optimal credit demand, you will be able to derive the optimal money demand. These two questions are done at the same time. Now let's move on to the third learning objective. That is how to determine the interest rate. Interest rate is the price of the money market. We have discussed money supply, the supply side of the money market in the previous lecture. And now we have finished the story on the demand side of the money market. Once you combine the supply side and demand side, we'll be able to determine the equilibrium interest rate, just like in any market. So when we discuss the demand for money, we actually treat the price of money, that is the nominal interest rate, as given. This is the same for any other markets. When we discuss the real business cycle model, like in the labor market, the price of labor, which is the wage, is treated as exogenous to individuals. And when we discuss the credit market or capital market, the interest rate, the real interest rate, is treated as exogenous to individuals. And similarly here, when we discuss the money market, the interest rate, this time it is the nominal interest rate, is treated as given to individual firms and individual consumers when they make decisions. So we are basically consistent when we discuss different markets. In this case, we treat nominal interest rate as given, so everyone is a price taker. So how do we determine this nominal interest rate, the price of money? It is determined just like other markets when the supply side and demand side are equal, or in economic jargons, it means the market has to clear. So in general equilibrium, all markets clear. No one wants more or less money or credit or labor or capital or output in the output market. So all the markets has to clear. One implication here is that there's no arbitrage opportunities across markets or within markets. So if you think the supply side would like more of money or credit or labor or capital than the demand side, then there must be some arbitrage opportunities for some people to profit. So in this case, there will be some more activities and interactions so that there's no arbitrage opportunities left in equilibrium. In this case, in the money market, we will assume the same thing, and no arbitrage opportunity exists. No arbitrage condition means that you have no chance of generating any excessive returns in one market over any other market. So in our case, if you have money, you have two ways of investment. The first one is you invest your cash into the bank, and then next period you will get 1 plus R as the return. Alternatively, you can use your money to purchase a unit of output in the current period, and then put this unit of output into the real economy, like growing more wheat or setting up a new factory. And then you will get some profit, and this profit will be equal to R as the return to your investment of that unit of output. So this 1 plus R and 1 plus little r has to be connected some way so that you don't have any extra arbitrage opportunity. This is required by the no arbitrage condition. And this is what we are going to derive, the Fisher equation. The big R must be equal to or approximately equal to the little r, the real interest rate, plus inflation rate. Okay, this is called Fisher equation because the economist Fisher invented this. And this equation describes the fundamental link between the monetary side of the economy and the real side of the economy. And we are going to derive this equation in the next slide. Now let's use an example to show you how to derive this Fisher equation, the relationship between the nominal and real interest rate. Imagine you have 1 unit of output, let's say a potato, to invest. You have 2 ways of doing that. The first way is to invest in the real economy, treating this potato as your physical capital. Or you can invest in the financial market, treating that as a financial capital. So how do you do that? And if it is invested in the real economy, grow this potato into the ground, and next year you will get another several potato out. And this return of growing in the ground or investment in the real economy is equal to 1 plus R. So 1 potato gives you 1 plus R potatoes. That is the return. What if you invested in the financial market? How do you do that? First, you have to sell this output at the current price, P. Okay, this P is the nominal price of your output. You have to sell it and get your money back, this P pounds, to sell your potato, because you can only use cash to invest in the financial market. You can't use potatoes to invest, right? So that's the first step. The second step, you deposit the cash of your money, which is obtained by selling your potato, into the bank, because the bank has received your deposit, and then next year you will get a nominal interest rate, 1 plus R. R, the big R, is the nominal interest rate. So basically you invest P pounds and you get P multiplied by 1 plus big R pounds back in the next period. If you want to compare your returns in the 2 markets, you have to compare it like with like, right? In the first scenario, you invest using the real units and you get the real units back. So everything is in real units. But in the second investment, you are using the cash, you're using the money to invest. So you have to convert the nominal values into the real values. To do that, you basically divide your future value of your investment, that is P multiplied by 1 plus R, by the future price of your output, so that you can compare the real value of your return in both cases. Therefore, if there is no arbitrage condition, the two returns must be equal, right? You can either invest in the physical capital market or financial capital market, and the two returns in terms of the real units must be equal. What we do is to do some transformation and approximation. So if you divide through this P and P prime to the other hand side, you can, and then reverse the left hand side and right hand side, you will have 1 plus big R equals to 1 plus little r multiplied by P prime divided by P, right? And P prime divided by P is actually the definition of inflation, right? Because P prime is the price level in the future and P is the price level of today. So that is basically 1 plus inflation rate. After this step, you will have to multiply out the brackets. So on the right hand side, it becomes 1 plus R plus I plus R multiplied by I. And this R and I are both fractions, and the product between two fractions will be very, very small, and it is ignorable because it's very, very small, so we can just get rid of it. Approximately, R will be equal to little r plus inflation, I, because 1 has cancelled out on both hand side. This little r multiplied by I is ignored. So that's why we have an approximation equal to here. This is what we have as the Fisher equation. The nominal interest rate has to be approximately equal to the real interest rate plus inflation. This is a graph to show you the historical relationship between the nominal interest rate and real interest rate. The blue line is nominal and the black line is the real interest rate. So the gap is inflation. Most of the time, the nominal interest rate is higher than the real interest rate because you have a positive inflation. But in very, very rare cases, like in the 1950s and 1910s, you have a higher real interest rate than the nominal interest rate. In these cases, very extreme cases, you have a deflation. That means the inflation is negative. So the nominal interest rate is even lower than the real interest rate. Now let's summarize what we have done in this lecture. We have 3 learning objectives, and the first 2 are actually correlated because the demand for money is closely associated with the demand for the alternative payment method. It boils down to an optimization problem on choosing the optimal mix between the cash payment and credit payment. And based on this logic, we derived the optimal money demand function. And then we combine the supply side and demand side of the money market to derive a no arbitrage condition based on which we have derived our Fisher equation. And in this Fisher equation, we can determine the optimal or equilibrium nominal interest rate, which is the price of the money market. You can read more on Williamson chapter 12 for more details, but please do have some time to test yourself using the self-test question and the tutorial questions. Have fun